Hey, what's up, stock compounders? Brad here. So, Fundsmith had their annual meeting last week. It's an hour and a half on YouTube. I wanted to share my highlights from the annual meeting. Terry Smith is a guy I paid very close attention to, and there are so many gems in this annual meeting. So, I highly recommend you watch it. I will point to certain points in this video that I think are very much worth watching, particularly when Terry talks about Meta or Facebook and Amazon. But again, I'll let you guys know where those points are in this video so you can dive into those specifically. So first, how did Fundsmith perform in 2021? Now, if you look at the top here, you see under Fundsmith, buy good companies, don't overpay, do nothing. Okay, so we're going to look at how Fundsmith did, according to those kind of three guiding principles. So the first one, buy good companies. These are the look-through ratios from 2014 all the way through 2021. If you look at the Fundsmith portfolio as a whole, through the lens of these 5 operating financial ratios, how do the Fundsmith companies compare to the indices, the S&P 500 and the FTSE 100 in the UK? So the first one is return on capital employed. Now, the way Terry talks about return on capital employed, he says for every dollar of capital we own in these companies, we're getting 28 cents of profit return. Okay, and if you compare that to the indices, it's pretty close to twice as high in terms of profit return on capital employed for the Fundsmith portfolio. So Terry Smith thinks this is the number one indicator, the single most important metric for business quality, return on capital employed. Now, I'll only touch on the first two here. The second metric, gross margin. He says our companies make stuff for 36 cents, right? The gross margin is 64%. We make stuff for 36 cents and sell them for $1. As compared to the indices, which make stuff for 55 cents and sell them for $1. Now, this is the single biggest defense against inflation, okay? If it costs you less in raw materials to make the products that you're selling to your customers as a percentage of revenue, you have less susceptibility to inflation, right? Increase in cost of goods sold. So this, Terry Smith thinks is very important, especially in the environment that we're in with rising inflation. So those are the first two. I'll just kind of mention. Of course, there are 3 others as well if you want to dig into that. The second point, don't overpay. Now, the Fundsmith companies as a whole are 25% more expensive than companies that make up the S&P 500. If you look at it on a free cash flow yield basis, so that's the free cash flow that was generated by the company divided by the market capitalization of the company, free cash flow yield. But you have to ask yourself, you're paying more for these businesses, right? But you're paying more because they're better businesses. They're quality businesses. So the question you have to ask, is the quality of our companies even higher than this premium that we're paying for them? And I also want to point out the free cash flow for the Fundsmith companies grew 20% in 2021. Okay, so Terry Smith would point out our companies are growing faster than the market and they have better operating ratios. Okay, as you can see here, the look-through ratios. And then do nothing. So there were 2 purchases in 2021 for Fundsmith, Amazon and Alphabet or Google. Amazon and Alphabet, there were 4 sales in 2021. Intertech, Sage, Becton Dickinson, and Intercontinental Hotels Group. And Terry Smith points out, he talks a bit about Amazon later on, and I'll touch on that. But Google, why did he buy Google? Google is another route for us to play the digital advertising market. Okay? Facebook is a large position for Fundsmith, and now Google kind of adds to that exposure to that digital advertising market that's really pushing out the more kind of traditional advertising avenues, really coming to dominate the advertising space, this digital ads. It's also a third force in the cloud computing infrastructure market. Okay, so you've got Amazon with AWS, kind of the dominant player in cloud computing. You've got Microsoft, which Fundsmith also owns, and now you've got Alphabet. It's kind of the number 3 in line in terms of that cloud computing infrastructure. So clearly, a sector that Fundsmith really wants exposure to, cloud computing. So that's kind of an overview of, good companies, don't overpay, do nothing. And then we get into the Q&A portion. So first point here that jumped out at me. The main determinant of our investment outcome, right, as a Fundsmith, is owning good businesses which will persist in being able to invest at high returns on capital. Okay? Will persist in being able to invest at high returns on capital, and whether we have the patience and fortitude to stick with them. Okay, so that's the do nothing piece. Own great businesses, don't pay too much, do nothing, hold on to them. Something I want to drill into my own head, that point. Next, he talks about Facebook, Meta. There's a lot of talk about how all of this CapEx, right, how all of this spending from Facebook on the metaverse, Reality Labs, is speculative. Okay, Pabrai talks about that as well. He thinks it's highly speculative. Now, Fundsmith's perspective on this is the people who treat the metaverse as something weird and speculative, I think we'll probably look back in amusement in 5 or 10 years that we thought the metaverse was something weird, because we'll all be living in it then. Okay, strong statement there. Oh, metaverse aside, the core business of Meta is in digital advertising. Okay, there's 7 million people who are customers of this digital advertising product that Facebook has. So that's really the business. It's not the 2 billion daily active users. It's the 7 million people, business operators who are paying for ads on Facebook. Now, Fundsmith owns that core business, right? That digital ads business at a price to earnings ratio of 14. And Terry Smith thinks that is, very acceptable to own such an incredible digital advertising business at a price to earnings ratio of 14. So, and Monish Pabrai and Divya Narendra got quite a bit into that in their talk, the Sum Zero talk about Facebook. So check that out if you guys are interested in Meta. Terry Smith would say the more interesting question regarding all of this spending that Meta is doing on the metaverse. If they stop spending money on the metaverse, will their future be better or worse? Okay. So I'll leave you with that. And then this was an interesting point. I didn't know this. Meta is laying a fiber optic cable around the coast of Africa, which he believes is about as long as the circumference of the world. Why are they doing this? Why is Facebook spending so much money to lay a fiber optic cable around Africa? All those people in Africa, which might be a potential market for its services, certainly aren't going to be an actual market for its services if they can't access it, right? They don't have access to the internet. So I learned something new there. Next, Terry Smith talks about Amazon, right? For a long time, Terry was opposed to owning Amazon. The return on invested capital, return on capital employed, it just wasn't there. Return on equity. The return figures just weren't where they needed to be for Fundsmith. Why did you change your mind on Amazon? He says, our view changed a bit and Amazon's business changed a bit. Right? So it was a combination of those things. The returns have started to come through an awful lot better. We've always liked Amazon Web Services, okay, cloud computing infrastructure, which I mentioned before. It's got decades of growth ahead, in the opinion of Terry Smith. The breakdown of first-party to third-party revenues is improving for the e-commerce platform. The financial characteristics are quite different between first-party and third-party. For third-party sales, all that shows up in the revenue line is the commission, okay? And they don't carry any working capital for third-party sales. Third-party is far better than first-party. It's much closer to pure profit, doesn't have much capital strain, and third-party is now 56% of sales, okay? So they like that a lot, okay? Much more attractive financial characteristics, shifting to more and more third-party on the e-commerce platform. Now, Prime, this is kind of the second point that Terry Smith gets at. Prime is a very powerful engine with north of 200 million members, okay? Costco, for comparison, has 61 million members. And Terry points out, just recently in the US, Prime went up from $119 per year to $139 per year. Now that $20 increase is $2 billion, okay, in profit for Amazon. Just that one tweak. So, you know, you've got to think, is that $139 per year for Prime members in the US? Is that a lot? Is it a little? How much can they raise that going forward? That's a very powerful thing. And it's not just, you know, the recurring revenue they're collecting from that Prime service. You got to understand that there's a psychological benefit here. When you're paying a membership fee for something, this is very true with Costco. I feel it with Costco. I go to Costco every month. Because I have a sunk cost with Costco. I'm paying that membership fee every year. Anything I buy, I want to make sure if I can buy it at Costco, I'm buying it at Costco. Okay, first of all, it's already the cheapest at Costco, but there's also, you know, I have this loyalty to Costco. I really want to get all the bang for my buck that I can get because I have a subscription. And this plays just as large of a factor with Amazon Prime. And then he talks about advertising. Okay, advertising will gain share due to Apple's changes for data collection, okay, which has really kind of been a headwind for Facebook or Meta. But Amazon, that advertising piece of the business is growing very fast. And, it's got a lot of autonomy in terms of the data being collected by Amazon. They don't have to go through a platform like Apple or Android in order to get all of the data about what their customers are doing when they're being shown ads and whatnot. So that's very powerful. And then there's really just one more piece I want to touch on here. He was asked, how do you get comfortable with the portfolio's free cash flow yield declining? Okay, it's at 2.7% today versus 5.8% in 2011 when Fundsmith started. How do you get comfortable with such a lower kind of portfolio free cash flow yield today? And how do you make sense of that with this idea of not overpaying for companies, right? The second point here, don't overpay. Terry Smith's response, there's no such thing as an absolute valuation. So we can't compare, what we're paying for companies today with what we were paying for companies in 2011. It's all relative. Everything is always relative to something. Companies of the kind we buy will be compared with long bond yields. Okay, if long bond yields are coming down, it's going to put downward pressure on the free cash flow yields for these great businesses. So we are inevitably, to some degree, subject to the vagaries of what happens in terms of the discount rate or the long bond yields. And then he gives this rule of thumb from Warren Buffett and from others. And the rule of thumb is if you can invest in a quality company, one where you can foresee growth and pretty consistent returns, and you can buy it at a free cash flow yield at or higher than the long bond yield, just buy it. Okay? The long bond coupon doesn't grow. Companies' yields will grow. Okay? If you have this kind of a business, a quality company where you can foresee growth and pretty consistent returns. So I got curious, what are the free cash flow yields of kind of the bigger bets in the Fundsmith portfolio, and how do they compare to the long bond yield? So I did a little exercise here. I put it up on Twitter. People seem to really like it. And I put that quote up, the one I just shared with you guys. Below are the free cash flow yields of Fundsmith's biggest bets. So this is basically 2% or higher of Fundsmith's portfolio. See, the biggest holding is Microsoft with 8%, and then right down to 2%. And I simply sorted this by free cash flow yield. And you can see down here the long bond yield. This is the 10-year Treasury yield, is 2.3%. Okay, so the vast majority of these companies have a free cash flow yield above the long bond yield. Now, Amazon was discussed in this annual meeting, and they think, within 2 or 3 years, Amazon will also have a free cash flow yield kind of north of the portfolio average of 2.7%. So they don't have it now, but that's what they're anticipating. A few tweaks here I want to mention. So one of my data sources for this was ROIC.ai, and there must have been a wrong number in here because PepsiCo does not have a free cash flow yield of 5.2%. It's like 3%. So I updated that. Sorry, guys. On my end, but it's still wrong in my tweet. And then Johnson & Johnson was actually sold in February of 2022. So it doesn't show up on the 13F yet, but it's no longer in the Fundsmith portfolio. So I would scratch out Johnson and Johnson here. But other than that, here's the higher conviction bets from Fundsmith and what the current free cash flow yield is, or I should say, the free cash flow yield based on 2021 free cash flow and today's market cap. So hopefully that's of value to some of you. And my voice is going. So I think that's all I wanted to say anyway. But yeah, I'm so excited that Terry Smith is doing more of these talks, right? He does the annual meetings every year, but he's doing more and more podcasts, and seems like quarterly he's putting out content, which is fantastic. He's one of my favorite investors in terms of kind of long-term buy and hold. So that's what I got for you guys. Hopefully you enjoyed this, and do watch this whole annual meeting. If you just want to see the pieces on Facebook, go to 43 minutes and start there. Amazon starts at around 48 minutes in this annual meeting. So I'll leave it there, and thank you all for watching. I'll see you in the next video. Take care.